Hi, good morning, everyone. It's the third session, I think, of the Built Not Born program from the WebEngage Startup team. We're trying to get more and more people into the conversation to say that building a robust business is still possible in these kind of times. It's an interesting time where the number of unicorns that are born every week is now available. You had one a year, now you have pretty much one coming every week. So we have Rahul Chowdhri with us. He's one of the partners at Stellaris Venture Partners. He's been a venture capitalist for almost 14 years now, if I'm not wrong. And he's been involved with multiple spaces. There is D2C, there is education. I also see some B2B SaaS play, which is already exited with Slintel. So lots of interesting experiences, lots of interesting journey that has happened. I would love to welcome Rahul on board to this conversation, and maybe he can just tell us some of his favorite stories from the last 14 years himself, and we move over to our agenda.
Thanks, Ankur. Thanks for getting me on the show. Maybe briefly, I started investing from 2007 onwards. That's when I joined a fund called Helion. So before that, had about 7 years of operating experience, 2 years of consulting experience. But my investing journey was at a very interesting time because that is when ventures started in India around 2006-7 is when most of the venture funds got created. So I was really lucky to have seen some, days when India had like I would say 2 million broadband connections. Then at one point in time, we had 20 million internet users in 2007 and 8. I remember Helion investing in Make My Trip, and they used to have some few thousand call center agents to take online bookings to where we are now. So have seen a lot of interesting companies. Some of the first offline to online models get creating. Was lucky to be part of companies like LiveSpace, Big Basket, ID Fresh at Helion, Proper, Simplilearn, and all. And then at Stellaris since 2016. As a fund, we are an early stage fund, invest in C to Series A companies, broad based. Again, very fortunate to be associated with companies like Mamaearth, Whatfix, Lintel, Mfine, Loadshare, Signsy, and so on. So yeah, I'm very excited about how things are going right now in the startup ecosystem.
Awesome. So maybe the first question I would just have for you is, with the 14 years of experience, what is your overarching view on the current state of the ecosystem?
So, and this was a framework we used to have even 10 years back, which is that for any venture ecosystem to flourish, there are three things that are needed. One is the entrepreneurial talent, second is capital, and third is market, right? And I would say every 3-4 year bucket, if I see from 2007 onward, things have only improved. And in the last 3-4 years, I feel we have much better talent to start companies than what it was, let's say, in 2015-16. The amount of capital and the attention India has globally, both from private and public side, again, is at an unprecedented level. And market also has expanded a lot, not only in India, as in obviously, COVID has been unfortunate, but it also led to a lot of online usage, behavior change. But also, global market has opened to Indian companies. So in that sense, all three things have become better than what they ever were, and we are quite excited about a new set of companies that we are seeing now compared to maybe 3 years back. Uh, Capital wise, as I said, private public is there, but now there's more specialized capital. People who do Series B, Series C, Series D, and it is not limited to 2-3 large funds globally who will come in your D and E's. There are so many more funds that are available at a later stage also. So overall positive for the next 10 years. If you
Yeah.
look at, you know, and when we were raising our first fund, we had built a slide, and I think Alok had tweeted about this, that we had predicted that in 2025 we'll have $500 billion of tech market cap.
Okay.
And we were doing some math, and we can argue about whether these valuations are right or wrong. But with the unicorns that we have, we are now already, far way ahead of achieving that 500 billion.
Wow.
So clearly, next 10 years are another golden decade for Indian tech startup in my view.
But so you've also seen a bunch of cycles there, right? Typically, after every spike, there tends to be a bit of a bust. So I'm just, when you're saying 10 years, are we headed towards like a long bull run in a consistent fashion as you see it?
So it's
Or,
hard for me to predict, but in our assumption, we believe there will be downturns. And whenever there is a, and this is like a stock market, right?
Right.
Whenever there is a high which is much higher than, let's say, how economy are growing or companies are growing, we do hit a point where investors as a group realize that they're paying up too much, and then they start slowing down. Same thing, and I've seen that in 2008, 12, 15, and I don't see
Like,
that being different here. Now, when it will it be tomorrow or will it be 6 months or 1 year down the line? That is hard to predict. This is why
right.
I was telling you long term, very positive. Short term, you have to be ready for ups and downs, and that is
Yep.
how this journey is.
Absolutely. So, I mean, I would only worry if we have a situation like 2001, whereas it was a bit of a bloodbath. But beyond that, everything is par for the course, right? So, in terms of the way I see it, you seem to say that this is the best time that has ever been for somebody to start up. You have great talent available, you have capital available, the market is ready. There's so much more enabling infrastructure. I would imagine the internet base, the mobile users, the logistics infrastructure, all that
True.
is a lot more in place than it was 10 years ago, right?
Yes, except one, just to be clear, when I said talent, I mean founder talent. I
Yes.
think a lot of money has also meant that next level talent is becoming very, very hard to get. Uh,
Demand supply equation, I would imagine,
exactly.
right? Sure. So, in general, the way you see this, the way the action has been panning out over the last few quarters, mostly I've heard startups are supposed to be running marathons. So you prepare for the long haul in a certain kind of disciplined fashion. But what now seems to be happening, and you saw that Slintel, sprints are also possible. You can do a great job, fast finish, get out in 2 years. And that's a perfectly viable alternative. Do you see that changing in the founder's mindset?
So, see, I feel that if you want, if see, we want to back companies who are looking for large outcome, because as investors, the risk we take when we come in seed or series A, it only makes sense when there's a very large outcome. And at least we try to find founders who are looking for those large outcomes. Now, on the way, the good part is, there are a lot more exit opportunities that each of our companies will get. And at that point of time, it is ours to evaluate what is a better option for the company. But in general, the idea is that go big. I think founders today are also very clear in the sense that they don't want to ride a dead horse. As in, they
Sure.
also understand there's an opportunity cost to their time. So they also figure out, if in 2 years things are not working out, let me get out. It may be a bad outcome or a okay type outcome, which is all fine. And at least as investors, we take that back. We assume that only 10,
Sure.
20% of our companies will become very big over a period of time. So in that sense, I would say the incentives are aligned, and these exit opportunities in the middle are good signs, because now it is not as if if you can't go public, there is no other outcome for me as a founder.
But that's somewhere. So one question was in terms of speed. That of course, you want to have very large outcomes, but the time window that used to be probably 7, 10 years earlier is now cut down to 2, 3 years. Is that something you see happening?
Which is positive. Yes, so I agree that the pace of scale up has also changed every 3 4 years. So the companies we invested in 2012, they took maybe 4 5 years to become large. Now it is possible to become large in 2 3 years. But I would say at the same time, founder ambitions are changing. So earlier, building a $1 billion company or an outcome was considered like the ultimate goal. Now people
Hmm.
are saying, why stop at a billion? Why not 5 billion? Why not 10 billion? So if you think of 5 billion outcome, maybe it is another 7 years kind of a journey. But I think time window to get to every $1 billion of outcome has compressed.
So
And
from the
I'm not
founders,
talking about valuation per se. I'm also talking about the size of the business, in
sure.
the sense how many
That's where
users, how much revenue. That is possible now in faster time frame.
absolutely. So that is where I was getting at that from a design perspective, when a founder is setting out on a journey to build a company, it's quite tempting to chase the unicorn dream and get really aggressive with it. And that's where, I mean, one would consider the rationality of making sure that you end up at that dream vis-a-vis taking some sort of aggressive steps which might just cut your journey short. Right. So do you see? So when you said that 20% of your founders will eventually make it really big, the remaining 80% will not. So, is there a pattern or a set of choices that you see these guys making, which end up slightly greater sign of the bigger outcome, right?
Yeah, so I would say at least in initial few years, the emphasis is on finding product market fit. If you figured it out, the emphasis is on growing. If you figure out the growth, then the emphasis is on getting margin structure right. Uh, Now, sometimes it does happen that when you have capital available, then our advice is take it earlier if need be. But as I was earlier saying, there will be cases where you may find you have taken too much capital earlier. And that is a balancing act. It is very hard. It's very easy in hindsight to say that I told you so, but very hard when a founder is saying, I see this market, I see this opportunity, I am getting money ahead of time. Why should I not take it and use it? And that always happens. Uh, and as a founder, again, it's a question of the personality of that founder. Uh, Ankur, are you there? Sorry, I don't know if.
I'm here. I can hear you.
Okay, your screen went away for a minute.
Okay.
So it is also a question of the personality of the founder as to how much can they digest, right?
And are
And
you able to assess that?
so see, the point is that when you have a lot of money sitting on your cash, then there is if nothing else, there is a pressure you put on yourself to deploy it also. It is very hard to say I'll keep this money in bank account. Once you have it, you also want to use it. You don't want to lose your number one status. You want to get into other markets. You want to build more products. So it will happen. And there are some founders who can very well adjust to that high growth, or exorbitant growth, if I can call it that way, and some who will not. So it's a I would say it's a cycle where you go through that journey, you realize you went wrong in few areas, you pull back, and then you start again. Uh, but I think that's part of building a large businesses. And if you want to build a $5 billion outcome in 7 years, that's part of the journey.
Sure. So, I mean, the mistakes are part of the journey and you will have learnings and lessons. The question would come more from a perspective where is the founder able to keep his eye on the PMF? Because that's the most likely disaster
True.
that you will have, right? You ramped up across the whole geography and you've not figured your core PMF yet. Some people might get lucky to become category leaders, but I don't know if that's how the founder should design their play, that they'll become category leaders.
Agreed. Which is why I was suggesting that first figure out your definition of PMF, then figure out your methodology of growth, and keep an eye on the margin. See, margin also is a question of different levels, right? There is a gross margin, there is a sales effort, and there is a margin after that. Then there is a EBITDA margin, and it's a question of where or what do you want to optimize when. So we do as early stage investors, at least our advice is to keep an eye on the gross margin. Now there will be 6 months where it doesn't matter. You figure out, and these are founders where the view is once you have scale, a lot of these margins can be figured out. So
Sure.
those 6 months of unprofitability stays, and which is all fine. As long as we are measuring, a lot of time I've seen founders don't even measure what is
That's the part
happening
I was
below the
very
revenue.
worried about, right? Because these are first time founders, whole lot of money in the bank. The bandwidth available from investors is ultimately finite. So the advisory ecosystem, the mentor ecosystem, the where you should kind of get those, reminders once in a while that this is stuff that you need to be cautious about. What's your observation there? I'm sure when
No.
you accepted a bunch of founders, you also said no to a whole bunch more.
So yeah, see, every VC fund has their own, I would say, recipe, and we all end up identifying with people who we are ourselves, right? So there are
Right.
set of founders that we invest behind where we have the view that they do look for both growth and profitability. What we have done as a fund is also we have what we call Stellaris Founder Network, which is we have some of the late stage founders who are investors in our fund.
Sure.
Now they have gone through these cycles. And what we do is we request few of them to invest along with us in our portfolio companies. And when that happens, they become de facto advisors who have their incentives also aligned.
Sure.
And the easiest thing to do to ask a portfolio CEO is to have a chat with them when things, when they need advice or
Sure.
generally meet them. Because I think that conversation kind of, tells what the journey of the late stage founder was. And hopefully there are learnings that get passed on, which then the CEO imbibes and changes how things are to be done. So at least we have seen that interaction be very useful in our portfolio founders journey.
But generally, given the age at which people are now raising meaningful money, do you see humility going for a toss that I don't need to learn and I'm all good? Something like that?
I won't say that. As in, I
Yeah.
think I think these some of these founders, and see, we always have people who
Of course.
who are outliers, but in general, I've seen founders also they are willing to learn from people they respect, and which is why I was saying that maybe I may not be the best person to advise on them on that area, but if they can interact with somebody who's built $1 billion revenue business, they can. When they are saying, then these founders understand they're speaking from experience, and let me also think maybe I'm missing something. So at least I've seen that never to be an issue.
Awesome. So, in terms of the availability of the late stage founders to give meaningful time and attention, of course, because it's your fund and you have relatively greater access, it will still remain finite somewhere. So, what kind of
Yeah, which
resources
is
do founders tap into?
see. So one is that at a fund level, we don't invest in like 30 companies a year, right?
Okay.
So we are ourselves quite measured in how we invest. So our investment pace maybe is around 10 companies a year. So
Okay.
it is not as if we need to get a lot of bandwidth from late stage founders. The other thing is these late stage founders actually will make out time if they find the startup interesting. So I have seen they figured out. I've seen founders, late stage founders who have kept their Saturday morning separate only for these interactions. They also see this as a way of learning, right?
Absolutely.
Because when you're running a large business, a lot of time you are not aware of the innovation that is happening in the industry. So it is a two-way street in that sense.
Sure.
And at least in our portfolio, we have never seen that to be a challenge that we are not getting time from these late stage founders.
Awesome.
Uh, if you are a very early stage company, yes, maybe you need to figure out your own believers from this ecosystem, whom you can
Hmm.
go and at least bounce off your thought process.
So one of the things I have started to hear is founders are choosing the investor. Also, I mean, the seasoned founders would choose the investors which have more than money to be given, vis-a-vis slightly, let's say, non-seasoned folks. I don't want to call them immature, who are just going by the check size. Do you see that happening? Because you're not necessarily the unicorn chaser. Somebody will give 5x valuation. There are people who do that, but that's not the approach that you've taken. So this is more of a mutual fit from your side to the founder and the founder's side to you guys. You're being very careful about the bandwidth side of things as well.
Yes, so I think what you are suggesting is happening, and that is a good sign because that way we find, see, we expose who we are. Uh, Now, if the other side, the founders have multiple choices, the good part is they also then know whom do they want to work with, and that way, as far as relationship post investment is concerned, it is much more seamless because then there is no misalignment of incentives. There is at least a common view. We may all have a wrong view, which is fine, but at least there is no dissonance on the board. Right. So I find this to be a very good development that founders have a choice today on whom do they want to take money from. And that also keeps investors on their toes, as in we have to evolve. If let's say 90% of the founder want X kind of investor and I'm not that investor, then I'll not be able to invest behind good founders. Right. So we also have to evolve along with what founders want.
Sure. So, given your focus is a seed to Series A kind of stage, this is the time when the bandwidth probably that the founders might need from the ecosystem might be probably more than at a slightly mature stage, right?
Yes. No, that is true. That is true. And we are willing to provide to be that bouncing board. At the same time, I don't believe that board members should provide the answers. We can only ask the right questions. It is
Hmm.
end of the day founder who has to figure out the right answer for their business, for their stage, for their industry. Uh, and at least when we invest, we try to judge for decisiveness, learning agility of these teams. Uh, because I have never run an education business. Now, how am I going to tell somebody in edtech that this is what you should do? Because most likely my
This is
advice will not be the right
a very
advice to begin
interesting point there, right? Because a lot of situations are now being blamed on the boards expecting slash driving the founders in a certain direction. Uh, in what context do you see that happening? And if founders have to be wary of the situation where they get into the weak position compared to the board and get influenced by the board more than you, what would be your input to founders there?
Yeah, first, as you had already hinted, choose the investors that you believe uh, have a sync with your philosophy. Uh, Good. The good part is today a good founder has multiple choices. 5 years back or 10 years back, that was not the case. Now that you have a choice, choose your partner correctly. Second, I would say when you have multiple investors, align the investors on a periodic basis. So let's say every 3 or 6 months, make sure that everybody is aligned on the next 3 month or a next 6 month direction. Because what happens is when things are aligned, we all understand what you're doing. When things are not aligned, every board meeting is just poking holes into why this number didn't happen, that number didn't happen, right? Uh, Third, being decisive. As in, end of the day, the failure and success of a company, I think, is attributed to the CEO, quote
Sure.
unquote, the founder. So you can take everybody's advice. If things go wrong, it will be blamed on you. If things go right, it will be blamed on you. Today, nobody can argue. They know one particular investor of Nika was responsible for what Nika is. Finally, it is the CEO, right? And
Sure.
if it had failed, it would be the same situation. So I think realizing that makes you feel that finally you have to take a call. So you have to stand up for yourself. You don't believe in something, don't do it just because your board is saying so. And as long
Hmm.
as you've taken care of the first two pieces, which is to get the right partner and aligning it, my assumption is, a lot of things can be controlled. Obviously, there will always be some outliers, but mostly you can do what you want to do.
So, in that sense, what should the 5 questions or 3 questions a founder should be asking of the fund beyond publicly available information to make sure that they're in sync with the ambition slash expectations?
Sorry, I may not answer your question in a very direct manner. It is like asking an investor, how do you figure out what is the right team to invest behind? And I can guarantee nobody can ever give you a straight answer on that question.
Sure.
So same thing is true on the other side. I think you need to understand the philosophy of the fund and the board member that you will be working with. A lot of that gets driven by talking to prior portfolio of that particular person or that fund on how they behaved in different situations. So talking to, let's say, one or two companies that didn't do well in the fund, or
Correct.
one or two companies who did very well, and what was the behavior of that board member over last 2 3 years, tells you a lot about that particular fund, the partner.
So you're
And
saying
today
that,
I can, like, we have given term sheets, valuation, everything agreed, and founders have said we will wait for 2 days and we do our own ref checks. And I think that's a very good sign. That way, you are getting into the right marriage, if I can call it
yeah.
that way.
So reputations are going to be built and perhaps destroyed by bad behavior now, is what you're saying.
Exactly.
But right now,
Yes.
this is not in public domain. It might start to get there soon, right? I mean, the reputations
Yeah,
of
I think if you have a good circle, founders get to talk to other founders, and that's a good part, right? As in each, I think most of the founders are quite open helping another startup if it is very critical in their journey. So I feel, and I like there are cases where I have said no to a team. Uh, One of our in a case where I have given a term sheet that I have connected them to somebody I've said no to, and people are very willing to be. So it's a one-on-one interaction, right? They know why it is so important to give them frank feedback,
yeah.
and I think it may not be like overtly public domain, but news do travel.
So you, in effect, the lesson for founders is to do a ref check on how the investor behaved in a good time and a bad time before you take the term
Exactly.
sheet, and
Also,
don't
also
get all
during the
starry-eyed
diligence, you
with the
get
dollar value.
sorry.
Don't get all starry-eyed with the dollar value on the check.
Exactly. Also, I would say during the diligence, you will get to see how convinced the investor is on your business, based on what kind of questions are they asking. Do they start giving you too much advice while they're doing diligence? Are they connecting you with people and helping you while they're doing diligence? So there are a lot of signs you see, which tells you about the behavior of that investor. And you may be a founder who want a lot of advice, which is your personality, so you may be okay with that. But there are a lot of founders who want to be independent, so don't get a board person whose habit is to give advice every time they walk into a board meeting.
So since you mentioned the
Right.
board, the whole constitution of the board is also a interesting topic, right? How do you make sure that there is this adult in the boardroom somewhere who kind of makes sure the sanity remains intact? And given that the CEO is often a first timer, how does he get the right mentorship at a leadership level or managing the board level? Again, ex-founders?
So obviously ex-founders matter. I would also say that don't get too many people early on, because that itself creates multiple viewpoints on the board. So a lot of time I've seen people say, let me raise money from three funds at the same time. Now, if you are a first time founder, you do risk a case where two out of three are thinking one way, one person is thinking another way, and then you'll have unnecessary conflict. When the business is early. See, when business is very late stage, right? Maybe those views can be useful. But when business is early, founder knows the best about how to build a company or how to build a product or what is the go-to market. So being careful about that piece is important. And as I say again and again, either you're a first time or a second time founder, board meetings have to be driven by founders. And I've had these cases where founders, board members are sending agendas. I think you can add an item, but it is the founder who should say, this is what I want to discuss, this is what matters to me. Yes, you can as a board member ask a question, but you have to get your outcome out of that board meeting, either in terms of questions, help, burning points. So life is all about taking control. So as a founder, you need to take control of the board meeting that you're creating, especially in
Fair
early
enough.
stage. Early stage is all about navigating very difficult turns, unknown turns. So board members can only be helpful so much.
So this is, I mean, I'm hoping somebody or the other captures this hard thing about hard things across all these topics you're talking about, right? Because the first time founders, I mean, I have tried being one before for a short period. There's just so much which we're just figuring out on the fly. So unless you have this ecosystem and network of people who give you very quick tactical inputs, it just goes haywire.
Yes,
And
very
that's,
true.
I mean, at the end of the day, 90% of the startups, I mean, even in your portfolio, perhaps in the anti portfolio, as you would call it, you will see people, there'll be a mortality between every stage of the funding, from C to Series A, Series A to Series B. There will be degrees of mortality. So I'm just curious that if there is an intervention that you would consider making at some level where the decision making, one of you, or some of the key decisions ended up hurting the company's long-term prospects. What was those mistakes be like? What was those wrong decisions be like?
So see, again, very company dependent or space dependent and time dependent. Uh, there have been cases where I may not have, or I may have asked the company to focus too early on margins, whereas they should have focused on growth. And if
Okay.
market in that case turned out to be right, they would have been able to raise more money
Hmm.
because they were focused on growth, but because maybe the consensus was to focus more on margin, it didn't turn out to be the right way. Sometimes it is hiring right people at right time. Uh, and again, getting team ahead of time and place is also very important. We miss out on those pieces in early stage of companies. Uh, Now that does mean more outflow as far as cost is concerned, but it does help the company in long term. Uh, you know, yeah, I would say these are two or three examples maybe where maybe I could have advised in a different way. Things could have turned out to be very different in long term.
So
Uh,
one of the research inputs I read was given that 90% startups fail, a big majority of them end up running out of capital. Now,
yes.
somewhere or the other, that's a choice between aggressive growth and ready for the next round, vis-a-vis making good use of the capital that you have available. So, what's your take on the best use of capital in the early days of the startup's life? Because there's so many things demanding attention and money, right?
So again, stage dependent. If you have PMF not figured
Let's
out, then
focus on
getting
the
your
to
product
Series
right.
A folks.
Yeah, so at seed stage, I would say more getting a product and customer feedback on whether they are liking, sticking, loving your product. Now, in some sectors, it is important to also get scale early on.
Okay.
So let's say I'm building a user-generated content website, right? So unless there is enough content, you will not get the flywheel going. Now that means that you need a certain amount of size of content and users going out there before PMF can be figured out. So that's a reverse case. Similarly, e-commerce marketplaces, right? Unless you have range and width,
Hmm.
you don't know whether customers will come and buy from you. So
So,
your outcome or the focus would be very different versus saying focus on gross margin from day one. Uh,
sure.
so so whatever
Com-
is the definition of PMF, that getting that and focusing on that is very important. Around Series A onwards, I would say getting at least if there is a PMF kind of insight, getting next set of functional leaders on board become important. Uh, and along with that, I think things like go to market also becomes important. Uh, because early on you will hack your way through, but maybe around Series A onwards, you at least want some rhythm of go to market getting established. Be it feet on street, be it digital marketing, be it organic, whatever you think should be one or two interesting channels. Uh, and then B onwards, again, the situation is very different. You are then saying, how do I get to be number one, number two? How do I keep on growing faster? Can I become 2x, 3x every year? And putting, maybe at that time, you start thinking of hiring CXOs. So, head of marketing, head of finance, all those functions start becoming important.
Sure. So you mentioned the word PMF quite a few times in the seed to Series A situation. And you see startups which are kind of scaling multiple cities. So an example of a hyper-local company which is looking at doing some specific set of products in a specific geography, probably working with apartment complexes and all. So I'm just curious that they have yet to fully sort out the retention or cohorts or whatever behavior you call it in a few apartments, and they're in 3 cities, 4 cities, setting up a sales team, in-house technology team, all that stuff. So that's what intrigues me. It puzzles me. It's a smart founder, probably, but what are they doing and why are they doing this?
So, as you know, some I think sometimes founders are also worried about somebody else will build a brand before they do. And let's say you have spent 6 months just figuring out the retention in first city, but by that time some competition takes over the remaining 3 cities. You don't want that to happen, and then
But
it
is
becomes
that
a function of
a
capital available in
real
day one.
fear? Is that a real fear? The market, I mean, India hasn't demonstrated one market leader will rule kind of
Yeah, but the
vision.
cost of entering a new market is very high. As in, if there is a competition established.
So maybe it's
So
established because that guy will also be figuring his PMF, right?
Huh.
But
So,
I
as I said, it's a question of, when we talk about grocery, given that you talked about hyperlocal delivery, it is an established, highly competitive market, right? Now, let's say you have figured out a new model and you're perfecting that in one city. Several of your existing competition might launch that model in other 2 cities or 3 cities. And that fear sometimes also means that you want to be in 4 cities in one go. Now, it has its own challenges. So I don't have a very good answer to what is the right thing to do. It
sure.
does become very situation dependent. But at least I don't find fault with that argument given the space that we are talking
But you have a certain amount of money in the bank, and you will
about.
have to demonstrate a certain pattern of growth when you want to go after the next money. Because I would imagine, what's the most important metric for a next stage founder, next stage investor? So you've raised seed money or maybe pre-Series A money. Now you're preparing to go to a Series A conversation. The most important thing that probably would get asked, I'm guessing, and you might correct me, would end up being about the traction and the growth demonstrated in the last whatever time, right?
So yeah, see, I don't have a very good answer again to that. So you're right. First of all, it's a question of how much money you have today.
Sure.
And let's say it's a question of 1 versus 4 cities. What
Hmm.
does that mean for your runway? Right? Because you can arguably have 4 times the runway if you're only in one city. Uh,
Yeah.
so, so then founders do have to make that choice, and they will go wrong. As in, they might run out of all the money in 6 months, and there's nobody willing to fund them. But I see it's again a choice. We sometimes we do things because we want certain outcome, and we go wrong. So as long as their existing investor and the founders are aligned, at least I don't find that argument to be faulty. And they need to be okay that in 6 9 months we may not have more money. My existing investors have already told me they can't support more. I still want to do it, but at least it's a conscious choice you've taken, right? Uh,
So the
and I've seen
founder,
companies who won because of that argument, companies who lost because of the argument.
yeah, so that's where perhaps the risk and reward scenario comes in. So you take a certain set of bets. If you pull those off, you get the next round of money, you have the path to glory. But a vast
Exactly.
majority don't pull that off because that's where the
Yes,
merger
and which
comes
is, see, that is the beauty of the entrepreneurial ecosystem, that as long as founders understand that it is going to be a 0 or 1 outcome.
Yeah, but
Uh,
does it have to be that way? Because that's what also intrigues. I mean, by nature, venture capital needs that power law and all of that. But for founders, the choices could be different.
so see, that is why Ankur was saying that you need to be consciously making that choice. If you're not even aware, then I have a
Sure.
challenge. that you not even thought about this, and then the day the money is run out, you're suddenly waiting and saying, I'm blaming this investor, that investor, because that is what they told me. That finally is your call as a founder. You could have grown slowly and achieved maybe what you achieved in 6 months, you could have achieved in 1 year, 2 years. But you are the one who took that call. And
Yeah.
I'm not sorry,
Leadership.
I'm not suggesting that what I advise an investor, which is why I'm
Sure.
saying there is certain blends of investors. Uh, so maybe as a founder, you choose the right set of investor for that kind of growth, and maybe that space demands market leadership before margins get proven.
But you
Uh,
need a lot. I mean, you need a certain size of check to really get to market leadership.
exactly. So, and maybe you find an investor who's saying do this, do that, and I'm coming in today, but I'll come in with more money tomorrow.
Fair.
So that is also a
So,
possible way to build this business.
So the angle that we've been kind of debating at WebEngage slash thrashing out from our intervention with this WebEngage startup program that we've launched, and that's the agenda around the whole thing that we're talking about today. The idea was the founders don't seem to be making conscious choices here, because if you
Hmm.
want to optimize your own outcomes as a founder, you want to maximize your chances of success. You tend to raise money much better when you don't need it as badly. If you're desperate for money, it's probably going to be harder to get. If you've made your burn rate at a certain level where you need a runway of I mean, you have a runway of 2 months and otherwise it's a do or die, then you're in a slightly desperate situation. What we seem to believe is if you're a founder with his eyes on retention, you could jolly well manage your runway, maybe a slightly tempered growth pace. It will not be as aggressive as somebody else might be, but you have a much better control of the situation. Is that a fair statement to make?
So I agree. See, there are a lot of sectors. So let's say in SaaS, there is no point trying to grow too fast. I would
Okay.
rather say get your churn rate under control, get your GTM under control. Pricing also can be evolved over a period of time. So you don't have to have the best pricing or the best ARPU on day one. Uh,
Hmm.
so there are some basics, even in online brands. At tech, see, there is no network effect, where there is no obvious number one, number two.
Hmm.
It makes total sense to while you're growing to focus on retention, customer satisfaction, and few other things, and that is the majority of industry is. So sorry, I was not suggesting that you go all in all out kind of a way.
No,
uh,
absolutely. No, so all in all out is the outcome when you get really aggressive with your growth without tracking your retention. That's the only way we see it.
exactly.
Because if you have your eyes on retention, then it'll likely be a matter of time delay, not a binary outcome very quickly. You might
Totally
delay the
agree.
next fundraise by a few months, but you'll at least be in a much better control of your situation.
Agree, totally agree. And at
So
least that's how most of our portfolio companies have grown. If
super.
I look back.
So I would love to see whatever you're in a position to share about, let's say, a Mamaearth on their early days, because D2C brands end up being a big part of our portfolio and effort. And a lot of these guys have ambitions and aspirations to grow to a certain scale. So what would be the initial focus areas for D2C companies, maybe in terms of CAC, maybe in terms of retention, maybe in terms of validating the size of the portfolio, the products that they're launching, how fast should they expand catalog, anything that you're in a position to share?
So again, things have changed over last 4 years, but at least I would say in early days of Mamaearth, there was a very, very big focus, and we still advise that to our companies on getting a brand right. And it is a bit of a fuzzy word, but when customers have a choice, who are they picking up? In a let's say one in a blind test. Second is when it is available on third-party marketplace, do they come back, do they speak positively about you, and not everything can be tracked from sales data, so there are a lot of other effort that you put in. So Mamaearth, I would say, for very early days used to do these brand tracking studies,
Okay.
even when they were less than 1 crore per month revenue. They would do that study to figure out where do they stand against Dove or J&J in just customer awareness, recall, product satisfaction, natural as a value proposition. So whatever is your value proposition, is customer identifying with it. So that is something that at least I my suggestion to every online brand founder is that yes, sales matter, margins matter, but keep an eye on this piece as well. That do customers love your brand, and there has to be certain value proposition about the brand that they love, or so that keeping that eye on that is very important. Margins very critical, because it's your own brand. You can very easily show high volumes by just discounting, But if there is no handle on margin, I find that long term you'll hurt the brand, then you know uh, positively influence it. Uh,
Hmm.
if it is not a very high repeat frequency, even CM2, which is post marketing margins, also matter. So at least I have a struggle when companies say I'm negative CM2 because the second and the third order will make money for me. And these are beauty
Sure.
product companies. I just struggle with that approach. Uh,
You prefer them to make money in their first order?
yeah, yeah, most of them should. As in, I don't see a reason why they should not.
But
Except,
given
except,
the huh,
except your direct website channel. There I can understand
right.
because that customer has a higher chance of being loyal to you.
Hmm.
But if you're selling on Amazon, Nika, as in, what is the chance that the same person will come and you can't track it also, right?
You have no idea.
So you can lose money on the first order, but all you know, you might be losing money on the second and the third order also
Sure,
from
but
the
I
same
mean, this
customer.
whole first versus second information, and I mean, as I know, is
It's not
not
even
exactly
available.
Amazon anyway. So there,
Yeah,
all you
there are
have
some
to
very
guess.
broad information I think nowadays Amazon provides,
Okay.
but you can't make your decisions on marketing based on that. So at least on third party marketplaces, I think focusing on CM2 also is very important for an online brand.
So for your own market, which is kind of where WebEngage can play a meaningful role in terms of assisting people with retention and tracking some of these metrics around how many people are coming back and whether they're buying more, buying less, is where what we thought might be a great input slash intervention in the lives of startup founders is to surface some of these metrics much better. That okay, you need to be tracking these four numbers. You might have a large product portfolio. Some of that part of the portfolio would do well for you. Some of it will not. Where it might lead us is when you call it for PMF in D2C ecosystem, I would imagine you identify your ICP, the ideal customer profile, which you can acquire for a low cost and which will likely remain loyal with you, which will likely buy more often from you, buy more categories from you. So would that be a fair way to look at, and the outcome might not be a unicorn perhaps because not every category has that kind of scale potential, but you would jolly well have a 150, 200 crore top line business because India is so large as a market. So, by design, as an investor, do you see that kind of outcomes being possible, being desirable?
So as a possible outcome, yes, definitely. I think they're if built in the right way, uh, we will have lots of 100 crore plus brands in this country because the
Ask me, please.
distribution part has been sorted out. Sorry,
No, please complete. I was
I'm saying the distribution, which is the biggest challenge that a lot of these new brands had, has been sorted with the online channel becoming quite large.
sure.
Uh, and I think a lot of D2C brand founders also struggle with building technology in house, and that is
Correct.
where getting the right tools for different pieces, including retention, customer nudges, and all, become quite important.
Sure. Absolutely. Thanks for that plug. So we're basically that sort of people, right? So asking in terms of the founder expectation, given that the outcome for every founder does not have to be having 5% of a 20 billion company, it could jolly well be owning 60% of a 200 crore top line, probably 5x revenue valuation or 6x revenue valuation company. That's a great outcome as well, right? But that's where
Yes.
you read economic times and you see, in my B school times, and I'm sure you would have seen that in Joka as well, the package is a new valuation somewhere. The whole feeling that you want to achieve a certain valuation ends up giving you that FOMO and changes your goals. So I wanted to be a marketing guy, but I entered iBanking because that was the best paymaster. Is that something you see happening?
Very much. And unfortunately, that's human tendency, right? As you rightly said, I can always be happy with the salary I earn. The day I realize a friend of mine earns more than me, suddenly I'm unhappy, right? So that is like more of,
That's how it is.
you need to have that self realization that even if your friend didn't earn more than you, I'm sure there are hundreds of people who earn more than you. So
Sure,
if you're not happy with what you have, unfortunately, you will become unhappy. And economic times is a very classic example. When you read those numbers, you
absolutely.
might be building a very good business, but then you start realizing, why am I not one of those people?
Because what I tend to worry is in that process, a whole bunch of very good businesses will get destroyed. Because it was
Uh,
a perfectly good 200 crore business, but now because it wanted to become 1,000, it just destroyed to zero.
Very true. That is the unfortunate part. So my suggestion again is that understand your strength. Yes, sometimes when you read those news, be careful because some of those businesses can cannibalize you. So you
Sure.
need to build your own company for whatever the differentiation or the moat you think will help you. But finally, understand who you are and build to your strength. I think if you are a good, this is my good analogy. If you are a good hockey player, don't compete in cricket. Then play a hockey game.
I think that's the sentence I'd love to quote from this conversation. So if you're a great hockey player, try and compete, not in cricket at least. And the other thing which I think you said, which is probably the one that should be the most important thing to remember for founders, is stay in control. You know what you want, and you should decide for yourself and not let the external influences, because there will be unicorns. And apparently now there's this new term I heard called unicorps. So ex unicorns. We get to see this in India yet, I guess. But
So,
I would
what
imagine
does
by the
that
nature of
mean?
unicorns are ex-unicorns, people who were unicorn and now they're dead.
Cops. Okay, got it.
Corpse. So it's a term which is used now, at least in some circles in the West. It's yet to come to India, but I worry it might not be very far ahead either, because at the end of the day, not everybody is building a business which has strong foundations.
Agreed.
So on that
No,
note, I think one last question I'd probably love to name before we have more questions from the audience. We'll see what we have. Is some of the stories of these amazing companies which you think are doing a great job at building real long-term valuable businesses. They might be deploying capital well. What's your favorite?
so two companies, and because I've been closely associated with both of them, I can say it with a lot of confidence. I'm sure there are lots of other companies doing it, but I would say Big Basket and Mamaearth. Like, I would love to work with both these founders time and again, irrespective of whatever business they build. Just because of how they think about building business. You know, Having an eye on growth, customer satisfaction, margin, execution. There's so many things a founder has to do, and both these companies have done it from very small to very large scale. So
Fair.
yeah.
So the founder ecosystem needs the right heroes, I think. Instead of the valuation of the company, just look at the guys who've built the best businesses. Great. Thank you so much for the time. Rahul, it's been very interesting. I hope this was useful and maybe a little bit eye opening for founders. I think the reminder about being in control will, to me, remain the most important statement made today. Siddharth, we have questions from the audience. You can let us know and we can address some of them. So, the question I have here is how do you ensure the runway you have is long enough? Is there a perfect answer to this?
Again, no
What's your
perfect
perfect
answer. At least the guidance that I give is that at least think of 18 months of runway from when you raise the round. And the math is keep yourself 12 months to execute, 6 months to fundraise for the next round. So that is a very broad math, because in 12 months you can achieve enough. You can do 2-3 experiments and achieve enough to say that it's a good time to raise the next round. Then you give yourself 6 months. Out of that 6 months, first 3 months, hopefully you have an investor. If you get into the second part of that 6 months, you start getting worried as a founder. So you don't want to get into that situation. So that is the broad math I suggest to founders.
So, don't
And longer
finish
the
all
better. Actually, the
six
answer
months
is
at least for sure. I mean, you might raise back to back after 6 months, but at least don't be in a situation where if you don't raise, you may not survive.
yeah.
So keep it 12 months for experiments and learning, because there will be mistakes, and keep 6 for the next raise on
Yes.
the conservative side somewhere. Okay, the second question is a tricky one, I would say. Given the way you just described the market, anybody you've seen done a great job on managing talent? Because, I mean, when salaries get doubled, you need to depend on more than money for it, right? So getting the right culture, right aspirations, right leadership principles, the great founders to work with, for instance, the personal brand of the founder. How do you solve for talent?
Yeah, very hard to. I also don't have a good answer. We all say uh, the right things, which is to empower people, build a good employee brand or an employer brand, sorry, in mind of prospective talent. Uh, Also options, and good part is now employees do value options. Uh, and hopefully some liquidity from that option over a period of time. I think that creates a good outcome, and people start believing in what you're building. But having that culture from day one is super critical. As in, again, both these companies I talked about, Mamaearth and Big Basket, had amazing internal. I won't call it amazing. Let me just take it back. It had a very consistent culture.
Okay.
Some people gel in that, some people will not, which is all fine. But at least you don't worry as much about people leaving for another 15%, 30% pay increase. They like what they're doing. Yes, we all get driven by financial numbers, but we also, feel that if I can see growth, if I enjoy coming to work every day, the chances of retention is higher.
Would you then have a message for the team members who are choosing careers right now? Because one of the things that again I tend to worry about is the example of that butterfly, right? There was this situation where it was trying to struggle out of a particular cocoon, I think, and somebody opened it up and it could never fly again. So what I tend to worry about is in companies which are growing super aggressively and they're spending insane amount of money on acquisition without as much an eye on the retention and sustainability, the employees also tend to start learning to take shortcuts, and that could be disastrous for the culture, right? Because you don't have an innovation DNA.
No, very true. And I will not name companies. There are few large companies that I never advise to have from, and mainly because of this reason. Because
Yep.
at a very high level, there is certain association of brand if you have spent 2 years in that company. And
Sure.
having interviewed 5 people from the company, you can see it is certain kind of thinking where they've not thought about three other things in the business. The only thing they think is top line, top line, top line. It doesn't matter how you achieve it. So
So the
yes, I totally agree that especially in early stage of your career, yes, money matters, but at the same time, do be careful in choosing the startup you want to work with. Uh, well, the good part is with the tech ecosystem growing, we will see a lot of value being created, and that value get distributed to employees also. So if you
sure.
are a good, let's say a good engineer, you will in 10 years earn a lot, right? Now, whether you join something for just money for next 1 year, but learn wrong tricks, at least I will not advise that way of thinking.
Sure. So this is quite an interesting time, I think, for talented folks because the way the salaries are jumping in that segment is also insane. And you see people like BharatPe offering BMW bikes and this and that. So it becomes hard for the companies who don't want to do that kind of stuff, but then they get forced into it. Anyhow, I think hiring is not the center of our ability to solve for people. I think that's a common topic most people have to deal with. Awesome. I see. I think the only thing I noticed I had notes on, which I thought I'll ask you. You mentioned the fact that you treat the investing relationship as a partnership, and I heard you say that you pick up, let's say, a finite number of companies every year so that you're able to do justice. So, what is your way of making the most justice to this partnership that you define?
So, see, partnerships make sense when both sides think of it as a win-win relationship, right? Uh, and what does that mean? What that means is that we need to have a common goal. I am a cog in getting an outcome for the company. And so is a founder, so are the employees. So as long as we understand we are all stakeholders for one single outcome. And it is not easy, but if we understand that, then we are all working towards common goal, right? Uh, so as a board member, at least that's my endeavor to think, and I'm a human being, so I'm sure I make mistakes, but at least the idea is to think how do you maximize the value of this business? Uh,
Right.
Now, if that means sometimes you have to be frank and harsh with the founders, so be it. But they also need to believe in what my goals are. If they don't feel that way, then I have done a bad job. Because we can't have biases of our own in making these decisions
Sure.
for the company. So yes, there are hard times, and one of the things at least I have done as an investor is try to get feedback from my own portfolio founders on an annual basis to see what could have I done differently. And it is very hard for them to be frank, but I hope there is sometimes I get to hear right messages so that I can improve as a board member. So yeah, as long as they also feel that I'm not overbearing, I'm acting in the best interest of the company. I have seen a lot of problems get solved just because of that.
Awesome. This is very interesting, Rahul. I fully appreciate a lot of these comments, and I'm quite sure our content team will take out a bunch of snippets from this conversation and want them to be quoted and get more circulated among these startup circles, simply because there's just so much people could learn from these insights. Thank you so much.
Thank you.
I guess we're done with our questions for now. We'd love to speak to you more often, probably share some of our portfolio learnings on the startup program with you guys as well. And yeah, look forward to being in touch.
Same here. Thanks a ton.
Thank you so much. Have a nice day ahead.